Welcome back to the deep dive. You know, we often find ourselves just lost in the noise of daily market headlines.
Oh, absolutely. The Fed's next move, some earnings miss, geopolitical flare-up.
Right. But if you zoom out, really zoom out, all that short-term drama just kind of evaporates, and you realize that equity markets, they move to the beat of a much, much slower drum.
A more cyclical one.
Exactly. So today, we are taking a deep dive into over a century of market data. We're tracking indices like the Dow all the way back to 1898.
And our mission really is to filter out all that distraction.
And find the true historical heartbeat of investing. This punishing cycle of, flatness and euphoria that really determines your returns over the long haul. So let's unpack that.
It's essential.
Yeah.
Understanding this history is absolutely key to gauging what we call market temperature.
Market temperature. I like that.
If you're only looking at the last few quarters, you can easily mistake a cyclical high for some, sustainable new normal. But when you look at the 50 or 100-year charts, a pattern emerges.
Yeah.
It's really critical. Long-term, sustained growth is always, and I mean always, punctuated by these surprisingly long, agonizing periods where returns just disappear.
And for those of you who want to track this market temperature day to day.
Right, there are tools for that.
Yeah.
Analyzing things that compare total market cap against economic output, sometimes it's called the Buffett Indicator, can give you really crucial context about market risk.
It helps you see beyond the daily stuff.
Exactly. It helps you understand the structural over- or undervaluation of the whole system.
And that leads us right into the stunning historical reality of the U.S. market. When we look at the Dow Jones Industrial Average, these periods of stagnation, they're not just minor dips.
No, not at all.
They are multi-decade flat lines that challenge the whole idea of continuous growth.
Let's start with the big one.
The famous 17-year... So if you bought the Dow in 1965, the index was sitting around 870. You could have held that position until 1981, and guess what? The Dow was still at 870.
17 years. Zero nominal return at the endpoints. It's incredible.
And that's just nominal, right?
That's the key. If we factor in the high inflation that, characterized the late 60s and 70s, your real purchasing power actually went down substantially.
So you were poorer.
You were much poorer in real terms. It's a profound lesson in psychology. You have to sit there for almost 2 decades watching the index gyrate wildly. It did just sit still.
Oh, I'm sure. Big drops, big rallies.
Huge drops and huge rallies inside that period, only to end up exactly where you started.
Okay, wait. So if the market was flat, was the U.S. economy flat during that time too?
Not at all. And that is the most critical point. The U.S. economy actually grew significantly from 1965 to 1981.
So there's a total disconnect.
A fundamental disconnect. It shows that economic health and immediate stock returns are not always in lockstep. The market in that period was essentially just working off a massive overvaluation from the prior boom.
So like a structural correction playing out over a generation.
That's a perfect way to put it. It was a painful cleanup phase.
But the reward for holding through all that pain, it must have been immense.
Absolutely. That correction, that cleanup, it cleared the way for the spectacular boom that followed. From 1982 to 1999, the Dow went from less than 900 to over 12,000.
Wow.
That period delivered annualized returns of about 15% a year. It's a powerful validation of that long-term upward bias, but, it required enduring this stagnation first.
And then, almost like clockwork, the pattern repeated itself. After that spectacular 90s boom, another flatline. The 12-year period from 1999, right after that millennium euphoria until around 2012, was, again, basically flat.
And that second flatline is just as destructive, but for different reasons. It didn't have the inflation drag of the first one, but it included the twin shocks of the dot-com bust and the 2008-2009 global financial crisis.
2 huge events.
Massive declines, peaks, troughs, followed by a huge comeback rally, only to net out to zero over 12 years. It just underscores how deeply cyclical these trends are.
So the U.S. shows us this brutal on-again, off-again switch, but is this just an American thing, or does this kind of cyclical pain play out everywhere?
Oh, it's universal. The underlying structure of moving between periods of, let's call it, extreme euphoria and extreme pessimism is global. Different markets hit these points at different times, but the pattern is there.
So let's look at just how brutal that shift can be. A classic case study. The NASDAQ.com bubble.
A perfect example.
The run-up was, it was incredible for 2 decades. From 1980 to 2000, the NASDAQ year returned something like 20% per year.
Building a truly monumental level of euphoria. A lot of it was centered on companies with, no proven business model.
And the correction was just immediate and destructive.
Staggering, a 75% decline. The index went from 5,000 down to 12,250.
And we have to emphasize, this wasn't just a few meme stocks.
No, this was a major broad-based index, the backbone of the tech world, losing 3/4 of its value.
And the most shocking statistic from that, the one that should really sink in for any long-term investor, is the recovery time.
It's the killer detail.
It took the NASDAQ a devastating 16 years to get back to its previous 5,000 peak.
And that 16-year wait happened even while those foundational companies, the future titans, Amazon, Apple, Netflix, were growing revenues and profits exponentially.
Wait, hold on. So if you have companies as transformative as Apple becoming the giant it is today, how on earth did the index still take 16 years to recover?
It just speaks to the sheer irrationality of the initial euphoria. The valuations in 2000 were so divorced from reality that even 2 decades of world-beating growth from the best innovators, it still had to work off the impossible expectations of that bubble.
So the gains weren't creating new wealth for people who bought at the top.
Not at all. Most of the gain from 2000 to 2016 went purely toward neutralizing the original overvaluation. That's it.
That is a very tough lesson in valuation. It tells us that if we see that kind of euphoric behavior now, we could be signing up for another decade plus of stagnation.
Exactly. The growth happens, but the investor doesn't benefit until the prior sins of valuation are absolved.
Okay, let's look at some other markets where economic growth was phenomenal, but the stock market just kind of shrugged.
Right, let's look at India and its Sensex index. India liberalized its economy around 1992 after a huge balance of payments crisis.
And that spurred massive growth, right, an economic renaissance.
World-altering growth for the country, but the market reaction?
Muted.
Muted is an understatement. Despite that explosion in GDP, the market was flat for the next 12 years.
Another huge disconnect.
Exactly. The market needed time to mature, to build regulatory confidence, and to shake out structural imbalances before it could truly reflect that economic reality.
And we see this everywhere. The German DAX, a core European index, had a similar flat line recently. No net returns over an 11-year stretch.
The pressure is universal.
But maybe the most illustrative example of this stagnation happening alongside enormous progress is South Korea's KOSPI index.
Oh, that's a great one.
Look at the 30-year span from 1989 to 2019. The KOSPI went from 1,000 to 2,000. That's just a little over 2% per year for 3 decades.
We call this the Samsung paradox. I mean, that 30-year window is the incredible world-changing rise of South Korea. We're talking about the emergence of global giants like Samsung, Hyundai, LG.
They fundamentally altered global tech and manufacturing.
And yet the broad equity index delivered virtually 0 meaningful returns. It just shows you how sticky and painful these flat lines can be.
So if Korea is a case study in a growth disconnect, then Japan. Japan is the worst-case scenario, the ultimate hangover after the mother of all bubbles.
Mother of all bubbles, for sure.
The Nikkei index peaked at a staggering 40,000 back in 1990. The exuberance was unbound. As the sources say, the bigger the party, the greater the hangover.
And man, that hangover has lasted a generation.
It has. By 2019, 29 years later, the Nikkei still hadn't returned to its peak. It was sitting at about 50% of the 1990 level.
Just think about the psychological toll. 3 decades, and you're still not back to par.
And the size of the bubble that caused this it's just hard to grasp today. It wasn't just stocks. Japan experienced the mother of all property bubbles.
Oh, yeah.
Here's the crucial detail. At the time, the Imperial Palace in Tokyo was valued at more than all the real estate in the entire state of California.
The entire state. It's a truly stunning measure of unsustainable euphoria.
And that destruction seeped into the corporate structure.
It did. The recovery is hampered not just by the asset destruction, but by a deep-seated corporate culture. Japanese companies famously tend to prioritize their employees, their banks, their stakeholders.
And shareholders are where on that list?
Much, much lower on the priority list.
And this structural issue, it leads to a fascinating valuation nuance, right?
It does. Because of this reluctance to cater to shareholders, you find many Japanese companies trading below cash. This is a genuine Ben Graham-era valuation. Their net current assets minus liabilities exceed their entire market cap.
They're fundamentally cheap.
Precisely. You see these wonderful deep value numbers, but the problem is the corporate boards are often unwilling to release that cash, either through buybacks or dividends.
So the cash is an illusion from a shareholder's perspective.
It's an illusion. The value is real on the balance sheet, but you can't unlock it. It's cheap, but it's stuck.
So this brings us back to synthesizing all of this. We see these cycles of painful flat lines and spectacular booms play out again and again across all these markets.
And the essential synthesis is this. Equity markets usually only clearly signal their true position, whether they're extremely cheap or extremely expensive, when they reach one of these dramatic extremes.
And that's a rare event.
Very rare. It happens maybe once every 15 or 20 years.
So if we apply this historical lens to the current landscape, based on the metrics from the time of this analysis, What do the signals tell us about market temperature?
Well, based on historical valuation extremes, you can clearly identify Japan and Korea as markets showing signs of being cheap. Korea, despite the impediments we talked about, language, culture, it's noted in the sources as a fertile hunting ground.
What kind of valuations are we talking about?
You can find quality stocks trading at valuations as low as 3 times earnings there. They're still working off those structural issues.
And the U.S. market?
The U.S. market, however, is not showing those extreme signals. It's certainly hard to find much that's outright cheap using these measures, but things aren't necessarily showing the mania level of 1999 either.
So somewhere in the middle.
They may be fully valued or only slightly above fully valued, which means they might need a long flatline period, but they could also grow into those valuations without needing a devastating crash.
So what does this all mean for you, the listener? The volatility, the flat lines, the multi-decade waits, it's all inherent to the market structure.
It is. You have to accept it.
You have to accept that the market moves in these long, painful cycles, not smooth, predictable upward lines.
And that acceptance is the critical strategy. What truly matters is how you manage the psychological toll during the downside and how accurately you gauge the upside potential during the booms. The key is just surviving the long cyclical corrections.
But there's a reassuring thought here, isn't there?
There is. And it's drawn from this whole century of history. Despite the deep flat lines and the brutal hangovers, in the long run, the market is fundamentally designed to move upward. Economic growth always seeks expansion. So focus on holding high-quality stocks that can survive those long cycles.
That is a phenomenal and necessary reminder. Now here's our provocative thought for you to chew on. Based on the historical patterns of euphoria, stagnation, and pessimism we've discussed today across the U.S., Japan, Korea, are the markets you follow currently closer to the agonizing flatline, the spectacular boom, or the brutal hangover phase? All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Always conduct your own due diligence before making investment decisions. And if you want to track total market temperature, we encourage you to search and download the iOS app Buffett Indicator from the Apple App Store today. If you want to listen to our full deep dive about this topic or access more advanced content, welcome